I get asked all the time what stocks I'm watching and whether certain names are worth buying. Today, I'll break down 7 stocks and tokens that have been getting a lot of attention lately. We'll cover everything from biotech and real estate to solar and crypto, giving you a quick overview and my take on each. The goal is to help you spot opportunities and red flags so you can dig deeper on your own. Remember, this isn't financial advice, just my research and opinions. Always do your own due diligence and invest based on your own situation. If you like this kind of breakdown, hit the like button and let's dive in. First up is YMABs Therapeutics, ticker YMABY, a commercial-stage biotech focused on antibody-based cancer treatments. This company is working at the cutting edge of immunotherapy, aiming to harness the body's own immune system to fight cancer in new and innovative ways. Their main product, DANYELZA, is FDA approved for a rare pediatric cancer, which is a huge milestone in biotech. This approval not only validates their science, but also opens the door to helping children with limited treatment options. Having an approved drug means real revenue and less risk than pre-revenue biotechs. It's a sign they've already cleared some of the toughest regulatory hurdles, and now they're generating sales. But the stock's been volatile, typical for this sector. Big swings on trial results and earnings. Investors should be prepared for sharp moves both up and down as news breaks. The big question, can they grow DANYELZA sales and advance their pipeline? Expanding into new indications or markets could be a game changer for their future. Biotech investing is all about betting on the science and the team. You want to see experienced leadership and a track record of moving drugs from lab to market. Check their cash burn. Do they have enough runway to fund research without diluting shareholders? Running out of cash is a real risk in this space, so financial health is key. Their future depends on expanding DANYELZA's use and getting new drugs through trials. Success here could mean significant growth, but setbacks are always possible. Any clinical setback could hit the stock hard. Negative trial results or regulatory delays can quickly erase gains. If you're risk-averse, this isn't for you. The ups and downs can be stressful and losses can be steep, but if you're looking for high-risk, high-reward plays and believe in their science, it's worth a closer look. The potential upside is significant if they execute well. Still, I'd want to see more pipeline progress and revenue growth before calling it a buy. Consistent execution is what separates winners from the rest. Watch for updates on new indications and trial results. These milestones can move the stock and shape the company's future. It's less risky than a pre-revenue biotech, but still speculative. There's a real product, but the story is far from finished. Do your homework, read their reports, and understand the competition. Know what sets them apart and where the risks lie. For now, it's on my watch list, not a strong buy. I'm waiting for more evidence of sustainable growth and pipeline momentum. The story hinges on future breakthroughs. Proceed with caution, and keep an eye on the next big update. Next up is Caliber Companies, ticker CWD, a middle-market real estate and alternative asset manager that's been gaining attention in the investment community. Caliber specializes in sourcing, acquiring, and managing a diverse portfolio of real estate assets, aiming to deliver attractive returns for its investors. They pool investor money into various funds to buy and actively manage real estate, earning both management and performance fees along the way. This structure allows individual investors to access deals that would otherwise be out of reach, and it aligns Caliber's interests with those of its clients. Their skin in the game approach, where management invests alongside clients, is a plus, showing confidence in their own deals. But the real estate market's been hit hard by rising interest rates, which have changed the landscape for everyone. Higher borrowing costs make new deals tougher to pencil out, and can put downward pressure on property values, especially in more leveraged transactions. Caliber focuses on the middle market. Think mid-sized office buildings, apartments, and commercial properties. A niche that could offer better deals and less competition than the mega deals big players chase. They're especially active in high-growth regions like the Southwest, targeting cities such as Phoenix and Dallas, which have seen strong population and job growth. This regional focus could help drive long-term performance. Risks, interest rate sensitivity, and execution are key. Bad deals, poor management, or misreading the market can hurt returns and erode investor confidence. Always check their assets under management, AUM, and track record. Are they growing, and have past funds performed well? Consistent growth and solid returns are good signs. Their business is cyclical and management-intensive, requiring constant attention to both market cycles and property operations. If you think rates will fall or that Caliber's team can successfully navigate this challenging environment, there's real upside potential here. But macro uncertainty like inflation, recession fears, and unpredictable rate moves is a big overhang for the sector. Personally, I'd wait for more clarity on interest rates and Caliber's performance before making a move. For now, it's a watchlist name, not a buy right now. Patience can pay off in real estate. Look for stable AUM growth, strong management execution, and a clear strategy for navigating market headwinds. The model works if the team delivers on its promises and adapts to changing conditions. For now, I'm staying on the sidelines, watching how they handle the current market. Real estate cycles can be brutal. Timing and discipline really matter in this space. Keep an eye on their quarterly results and any updates on their portfolio performance. If they prove resilience and can grow through the cycle, it could get interesting for investors. Until then, caution is warranted. Real estate rewards patience and careful analysis. Ontrak, Inc., ticker OTRK, is a telehealth and behavioral health company that leverages artificial intelligence and personalized coaching to help people manage chronic conditions. Their platform aims to bridge the gap between patients and care providers, using data-driven insights to improve outcomes and reduce healthcare costs. The core of their business model is to contract with major insurers, promising to improve patient health and ultimately cut costs for the insurance companies. But a few years ago they lost their two biggest clients, Aetna and Cigna, which absolutely crushed both revenue and investor confidence, sending the stock into a tailspin. Since then, it's been a turnaround story in progress. New management has stepped in, the company has restructured, and there's been a renewed push to sign up smaller regional health plans and diversify their client base. Still, the business today is just a fraction of what it once was, and cash burn remains a very real concern, with the company struggling to stabilize its finances. This is a classic high-risk, high-reward play, almost like buying a lottery ticket, where the odds are stacked against you but the potential payout is huge. If Ontrak can land new contracts and return to meaningful growth, the stock could rebound in a big way, rewarding those willing to take the risk. But the odds are long. Most corporate turnarounds fail, and bankruptcy is a real risk that can't be ignored. Competition in digital health is fierce, with new startups and established players crowding the space, and Ontrak's model may not scale as easily as hoped. For most investors, this is a clear avoid. There are simply too many red flags and uncertainties. Only consider it if you're truly comfortable with lottery ticket risk, and you see real, tangible evidence of a turnaround actually taking shape. Look for new contract wins, improving financials, and clear signs of operational progress before even thinking about buying shares. Right now, the story is simply too broken, with too many things that need to go right for a successful turnaround. There are much safer places for your money, with better odds and less drama. Turnarounds are notoriously tough. Don't bet the farm on this one. If you're still tempted, keep your position tiny. Think of it as a speculative flyer, not a core holding. Watch closely for concrete signs of progress, like new deals or a real improvement in cash flow. Otherwise, steer clear. The risk of total loss is extremely high. Personally, I'm not touching it, and you probably shouldn't either. SolarMax Technology, ticker SMXT, is a solar installer and developer operating in the US and China. The solar industry has strong long-term tailwinds, renewables are growing fast, but it's a tough, cyclical, low-margin business, heavily dependent on government policy and subsidies. SolarMax has struggled with consistent profitability and faces stiff competition from many small installers. Their US-China exposure is a double-edged sword: big markets, but big geopolitical risks. Debt is another concern. Capital-intensive businesses can get squeezed if rates rise. The stock's been volatile, especially after going public via SPAC. For me, the company-specific risks outweigh the industry tailwinds. There are better ways to play solar, like diversified ETFs or companies with stronger moats. I'd need to see a clear, sustained path to profitability before considering SMXT. Right now, it's too speculative. The sector is promising, but this stock isn't the best vehicle. Look for stronger, more focused solar plays. If you want solar exposure, diversify. I'm passing on this one. Visionary Holdings, ticker GV, is a conglomerate with Canadian education, real estate, and a legacy Chinese home furnishings business. Their main focus is a private high school in Canada for international students, mostly from China. The education business is stable, but the company's structure is confusing and lacks synergy. Multiple unrelated businesses make it hard to analyze and value. There's significant geopolitical and regulatory risk due to their China exposure. Financials are opaque and volatility is high. Delisting risk for Chinese companies is always present. If you can't easily explain how a company makes money, it's probably not a good investment. For me, GV is a clear avoid. Too many question marks and not enough focus. There are simpler, more transparent education plays out there. Skip this one. Now to crypto. Biconomy, ticker BICO, is a Web3 infrastructure project aiming to make decentralized apps as easy to use as regular apps. They enable gasless transactions and simplify blockchain complexity for users and developers. The BICO token is used for network fees, governance, and staking. If Web3 goes mainstream, projects like Biconomy could be huge. They have a first-mover advantage and real integrations with popular dApps. Risks: fierce competition, rapid tech changes, and the token's value depends on network adoption. If usage stalls or the crypto market tanks, BICO will suffer. Still, it's a fundamentally sound infrastructure play, better than most meme coins. If you're bullish on Web3, BICO is worth researching, but it's high risk. Only invest what you can afford to lose. Diversify and keep your allocation small. Watch for continued adoption and ecosystem growth. Infrastructure is a smarter crypto bet than chasing hype. Proceed carefully. Last up, Muse DAO's Muse token powers the NFT 20 protocol, which brings liquidity to NFTs by turning them into tradable ERC20 tokens. This lets users trade NFT collections easily, solving a big problem in the NFT market. Muse holders govern the protocol and earn rewards from trading fees. The model links token value directly to protocol usage, a plus. But the NFT market is extremely volatile and sentiment-driven. If NFT trading dries up, so does demand for Muse. There's also competition and the ever-present risk of smart contract exploits. This is a niche, high-risk play, betting on both NFTs and this specific protocol. If you're extremely bullish on NFTs, Muse could have upside. For most, it's too speculative and complex. Watch as a barometer for NFT market health, but invest cautiously. Understand the risks before diving in. I'm watching, not buying. That's a quick rundown of 7 very different stocks and tokens. Each has unique risks and rewards. There's no perfect investment. Use this as a starting point for your own research. What do you think? Are any of these on your radar? Let me know in the comments. If you found this helpful, hit like and subscribe for more breakdowns. Remember, this is not financial advice. Always do your own research. Thanks for watching, and I'll see you in the next one.